Alright, let's dive into something that's got the crypto world buzzing, and not in a good way. Imagine this, in just 25 minutes, $54 million in Bitcoin vanished. Gone. Poof. And it's not because of some sophisticated cyber heist or a market crash. No, this was a flaw in a hardware wallet, something that's supposed to be the Fort Knox of crypto storage. Personally, I think this story is a wake-up call, but it's also a fascinating dive into the vulnerabilities of even the most trusted systems. Let's break it down. First, the hook, $54 million stolen in 25 minutes. That's like a bank vault disappearing in the time it takes to watch an episode of your favorite show. What makes this really interesting is that it wasn't a hack in the traditional sense. It was a flaw in Coldcard hardware wallets, a device that's supposed to keep your Bitcoin keys offline and safe. But here's the kicker, the flaw wasn't in the hardware itself, it was in the firmware. Specifically, the way it generated keys. A detail I find fascinating is that the wallets affected were all holding more than 0.15 BTC, and many had been dormant for years. These weren't active traders, these were long-term holders who thought their assets were safe. Now, let's talk about what went wrong. Coldcard's firmware was supposed to pull wallet seeds, basically, the secret phrases that control your funds, from a massive, random pool. But according to reports, it wasn't doing that. Instead, it was relying on the chip's serial number and clock registers, which are not secret. From my perspective, this is a massive oversight. If you take a step back and think about it, this isn't just a bug, it's a fundamental failure in how the system was designed. What this really suggests is that even the most trusted tools in crypto can have critical weaknesses. What many people don't realize is that this isn't just about Coldcard. It's about the broader issue of trust in crypto infrastructure. Hardware wallets are marketed as the safest way to store your crypto, but this incident shows that they're not infallible. In my opinion, this raises a deeper question: how much should we rely on these devices? And what does this mean for the average crypto holder who's been told to keep your coins offline? Now, let's talk about the bigger picture. This heist happened at a time when Bitcoin is already under pressure. The price has dropped by about 50% since its October 2025 high, and just recently, it fell below $63,000. Add this hack to the mix, and you've got a perfect storm of bad news. Personally, I think this could erode trust in the market even further. If investors can't trust hardware wallets, where do they turn? And what does this mean for institutional adoption, which has been a big driver of Bitcoin's growth? One thing that immediately stands out is the timing. This hack comes amid a broader exodus from Bitcoin ETFs, with investors pulling out about $1 billion in late May and early June. Is this a coincidence? Or is it part of a larger trend of waning confidence in crypto? Research firm Presto suggests that Bitcoin's weakness might reflect broader shifts in investor sentiment, possibly tied to geopolitical tensions like US-Iran hostilities. But here's where I disagree. While external factors play a role, I think this hack is a crypto-specific problem. It's a reminder that the technology behind crypto is still evolving, and sometimes, it fails spectacularly. So, what's the takeaway here? In my opinion, this is a moment for the crypto community to pause and reflect. We've been so focused on adoption and growth that we've maybe overlooked the foundational issues. Hardware wallets are just one piece of the puzzle, but they're a critical one. If they're not secure, what is? And if we can't trust the tools we're using, how can we expect mainstream adoption to continue? What makes this really interesting is that it's not just about the money lost, though $54 million is no small amount. It's about the trust lost. Crypto is built on the idea of decentralization and security, but incidents like this remind us that we're still in the Wild West. Personally, I think this is a call to action for developers, regulators, and users alike. We need better standards, more transparency, and a deeper understanding of the risks we're taking. As we wrap up, I'll leave you with this thought: crypto is still young. It's innovative, it's exciting, but it's also fragile. Incidents like this are painful, but they're also necessary. They force us to confront the weaknesses in the system and work to fix them. So, here's my question for you: what do you think this means for the future of crypto? Is this a setback, or an opportunity to build something stronger? Let me know in the comments. I'm curious to hear your take.